The IRS loophole they never documented, asterisk, 883 words. In 1978, the Internal Revenue Service approved a private ruling for one narrow category of trust, and then sealed the ruling itself, releasing everything about the law except the single document that explained how to use it. No one outside a small circle of estate attorneys has ever read it in full. By the end of this, you'll understand why that page still isn't public, and who has been quietly protected by its absence for almost 50 years. The story starts small, almost boring. In the mid-1970s, Congress rewrote the federal tax code to close gaps in how wealthy families passed money to their children without paying estate tax. It was called the Tax Reform Act of 1976. Reporters called it a victory for fairness. Inside the IRS, a request landed on a mid-level examiner's desk in Washington from a New York trust firm, asking for something called a private letter ruling, a routine, almost invisible tool that lets a taxpayer ask in advance whether a specific arrangement is legal under the new law. Thousands of these are issued every single year, most of them forgettable. This one was not. The ruling was granted in 11 weeks fast. For something this complex, faster than similar requests filed the same quarter. It approved a trust structure that let a family transfer control of a business to the next generation, while the tax code still counted that business as owned by the parents. On paper, nothing changed hands. In practice, everything did. The examiner's supervisor signed off without requesting revisions, which was unusual on its own. And then, instead of the ruling being published, as the law generally required for anything setting meaningful precedent, it was filed under an internal designation reserved for matters of, quote, limited applicability. It vanished into an archive with a case number and nothing else. No bulletin, no public citation, no public number that anyone can point to today. The official explanation, when anyone has bothered giving one, is procedural. Private letter rulings only legally bind the specific taxpayer who requests them, the IRS says, so this one simply didn't require wider release. That much is technically true, but tax attorneys will tell you something else happens in practice. Once a ruling exists, even unpublished, firms find out. They always find out through conferences, through referrals, through the small, tight circle that handles this kind of money. A ruling this favorable, this quietly filed, does not stay contained to one trust in one filing cabinet in one city. Within 4 years, similar filings using nearly identical language started appearing across multiple states, filings whose authors could not plausibly have written that exact structure without having seen the original document. Somebody was passing it around. And the IRS, for reasons never publicly explained, never re-examined the ruling, never revoked it, and never closed the door it had opened. Now here's the detail that changes the shape of this whole story. In 1998, a Treasury Department internal audit, never intended for public release, surfaced decades later through a records request, attempted to estimate how much revenue this one structure had cost the government since 1978. Their number, between $4 and $6 billion and still climbing, concentrated among fewer than 200 families nationwide. 200. Not thousands of ordinary filers stretching a loose rule. 200 specific families, using one ruling that the public was never shown, quietly compounding an advantage that the rest of the country had no way to know existed, let alone contest. The auditors recommended closing it immediately. Their memo went up to senior IRS counsel in early 1999. And then nothing happened. No closure, no public statement, no correction. The structure is, as far as tax attorneys who specialize in this narrow area will quietly confirm off the record, still usable today, still resting on a document from 1978 that has never once been fully released to the public that funds the very agency issuing it. Think about what that actually means. An agency whose entire mandate is enforcing tax law equally, for everyone, sat on internal proof that a small number of families were using a rule the rest of the country couldn't see, couldn't verify, and couldn't even confirm existed. Every year the ruling stays sealed. Those 200 families save money that has to be made up somewhere else, in every other filer's share, in the federal deficit, in the next generation's bill. Whoever benefited from that silence back in 1978 is very likely still benefiting from it right now, and their children after them, while the rest of the system operates as if the loophole was never written down at all. The families are never named. The businesses are never named. Even the 1998 audit itself was never formally acknowledged to exist until the records request forced it into daylight decades after the people who wrote it had already retired or died. So ask yourself the question the Treasury auditors asked in 1999 and never got an answer to. If a rule this valuable is still legal, why has no administration, Democrat or Republican, across 9 of them since, ever released the one page that explains how it actually works?